Again, welcome everyone to our monthly miners portfolio webinar. Zach and I thought that today we would, for this month, do the presentation that we did in New York at the end of February and go through that because it does also address a lot of the current charts of many of the names that we're holding, and also because it wasn't recorded at the actual Trade Expo, gives us a chance to record it and have that video available. So to get started, my portion of the webinar, I wanted first to dispel some common myths about gold and silver that I'm sure many of you have heard or familiar with. And then after that, I will take a look at the big picture charts of gold and silver and the Huey, and then pass it on to Zach, who will take a look at some of the individual miners at the end. So the first myth that I wanted to address is the myth of monetary inflation affecting the price of gold and silver. So the myth goes, if the supply of fiat expands, thus reducing the value of each dollar, then the price of precious metals should rise proportionally. So basically you ask any economist and they will agree with this assumption. And the truth is really that the fact is that monetary inflation has been pretty much a constant occurrence for the past century, really only differing in degree of severity. The only 2 decades when the US experienced overall deflation was the 1920s and the 1930s, and during this period, the price of gold actually went up from about $20 in 1920 until the government fixed the price at $35 in 1934. The long-term annual average of inflation in the US is about 3.22%, so we'll use that as kind of a benchmark as far as which decades have more or less inflation. Between 1970 and 1980, during that decade, the average annual inflation was 7.06%, so that would be more than double that long-term average. And I'm sure many of you are familiar with that period, how much public attention was fixed on inflation. So it's really not surprising that it was deemed the reason that gold soared 2,000% during that decade. However, if you look one decade further, between 1980 and 1989, the annual average inflation was 5.51%. So continued to persist for another decade and was still well above that long-term average. You would think that during our causal relationship, or based on the causal relationship myth, that precious metals should have continued to rise as well during that time, even if at a slower pace. However, it was during that period that gold lost almost 60% of its value. So just another example of the empirical data not really agreeing with this widely accepted belief. And in fact, over the last 82 years of persistent inflation, gold and silver rose for only 20 of them. For 62 of those years, price went sideways or down. So while there are examples, obviously, of precious metals rising during times of inflation, there's really not close to enough empirical data to suggest any sort of causal relationship. So that myth busted. The next myth that I wanted to address is the one of quantitative easing having an effect on precious metal prices. Another widely accepted belief is that central bank stimulus in the form of quantitative easing or expansion of the base money supply drives precious metal prices higher. Opinion among economists was pretty much almost unanimous in 2008 when the Fed first announced its intentions to stimulate the economy in the form of quantitative easing, and that precious metals would benefit from this policy. With gold and silver already in a strong bull market that had begun almost a decade earlier, it seemed kind of like a no-brainer that their continued strength was due in at least part to the Fed's actions. The second round of QE was announced in 2010, with the Fed then doubling down on its commitment and buying even more mortgage-backed securities and longer-dated treasuries. And this was all while the price of gold and silver continued to go up. So it just seemed like there was obviously a correlation, causal relationship there between the surge in precious metal prices and the bank stimulus by the Fed. So, certainly correlation there is undeniable, right? Well, not so fast. Precious metals went on to top in 2011 1 year before the Fed's third round of QE was announced, which was the largest yet. And this was an open-ended commitment to purchase 40 billion mortgage-backed securities per month. And if our correlation myth were true, then this should have continued to send metal skyrocketing even higher. But instead, actually the opposite happened. And the top was, as you can see from the chart here, pretty much right at the exact date that metals began to turn down and begin their multi-year bear market that we've just recently seen. So until the program concluded in December of 2013, gold slid by over 30%, with that largest portion of the quantitative easing really having no effect, or it was irrelevant to the overall trend of precious metals. The next myth that I want to address is central banks and the idea that targeted central bank buying and selling moves precious metals. You'd think surely heavy and direct central bank buying or selling of an investment item should cause its price to rise or fall, but let's go ahead and take a closer look at that. Pay attention to the chart here on the side, as far as you can see the gold transactions by central banks, and then this is the monthly price bars of gold price. So despite the huge and theoretically unlimited buying power of global central banks, their buying and selling of gold has in fact been inversely related to the price trend, as you can see from the chart here. Between 2000 and 2009, a period during which gold rose 5 times in value, central banks around the world were aggressively selling the precious metal. Their stance then became neutral between 2009 and 2010, during which gold then again doubled. And it wasn't actually until 2011, that central banks reported substantial inflows of gold transactions. And that was right when the most recent bear market in precious metals began, when we saw that top in 2011. And gold and silver lost more than 50% of their value each, respectively. So their persistent buying continued throughout the bear market, during which the price of gold was actually cut nearly in half. Even the directly administered investment policies of central banks failed to have any causal relationship or effect on the overall trend of gold, so another myth busted there. It actually would be interesting to see more up-to-date data and see if they started selling again near the bottom that we saw at the end of 2016. The final myth that I wanted to take a look at is interest rates. We've actually seen a lot of posts on this recently because the Fed has finally, since that rate hike that we had back in 2006, began finally starting hiking rates again. So people have been paying attention to that and trying to draw some sort of relationship between that and the current price of precious metals. But the myth is basically that rising interest rates are bullish for precious metals and falling interest rates are bearish. The idea basically being that interest rates must compete with precious metals for investment dollars. So rising interest rates would be bearish for gold, and the opposite true for falling interest rates. But let's take a look at the data. From 1970 through 1981, interest rates rose to their highest levels in U.S. history, a period during which, as we already talked about, gold soared over 2,000%. But that must be an outlier due to the heavy inflation at the time, right? There must be, another reason. We can find some other data points that correlate nicely with this idea, right? But it really wasn't the only outlier. The data over the years has been pretty clear. Interest rates rose as gold fell, rates plummeted as gold rose, rates soared again as gold continued to rise. And you can see all this happening here on the chart here. And then they began to fall as gold pulled back during this period in 2008, and then pretty much held near zero since that bottom that we saw in 2008 or early 2009, as gold continued to climb up into its 2011 top. So it wasn't until December of 2015, when the Fed announced its very first interest rate hike since 2006, that we actually put in that bottom that you guys all remember recently for precious metals, and the potential completion of their recent bear market. So obviously really no consistent relationship here between the two variables either, and to suggest any sort of causal relationship is really ad hoc. So another myth busted regarding interest rates having an effect or some sort of clear correlation with the price of precious metals. So anytime you see these sorts of articles on different sites or even posted by members on our own site, please kindly remind them of the actual empirical data, and that there really is nothing in any of those those four myths that we saw that really held any water when you looked at the actual charts and the data. So if these widely accepted exogenous effects do not actually drive the price of precious metals, then what does? I'm sure you all know the answer since you've been on our site. We think, obviously, sentiment, social mood, and those patterns based on Elliott wave theory. So let's take a look at those charts and those Elliott wave counts. I have the monthly chart up here for gold, and basically looks at that most recent bull market that we had at the end of 1999 up into the 2011 top, which was roughly a decade long, and overall about a 661% price increase from the low to the high in 2011. So the idea, if that is a wave 1, 5 waves up as a wave 1 at cycle degree, and we have a potential cycle degree wave 2 bottom at the late 2015 low, that gives us a projection of about 3 times the price increase over about 3 times the amount of time for that cycle degree wave 3. So a estimated price increase of reaching the more conservative 1382 extension of 1,550%. Next up on the silver chart, same kind of picture we have drawn here. The bull market recently into the 2011 top, and then the pullback, recent bear market into the late 2015 low. In this case, the wave 2, let's see, it was actually the wave 4 bottom. It was already in the wave 2. If you look back here, when gold put in its low in 1999, silver actually bottomed much earlier back here in 1991. So if you draw the same fib fan line between the low back in 1991 and the high that we had here in 2011, it gives us a little bit different of a timing projection for the cycle wave 3, and actually kind of places the wave 3 of 3 at the same timing on the previous chart for all of that cycle wave 3. And then the overall cycle wave 3 much later. So we'll kind of have to see how those discrepancies between, obviously, fib fans aren't necessarily the tell-all for timing to begin with, but they do help us gauge kind of when these intersections between timing and price, those fib lines that we're looking at for the price targets, may actually occur. So a little bit of discrepancy there between the silver and gold chart, but similar situation here, roughly 3 times the price increase over 3 times the amount of time of that original wave 1 to complete all of the cycle wave 3 at around a 3,800% price gain. And then finally, taking a look at the Huey chart, a little bit different picture here as well, but you can see the same bull market from, I think in this case it was 2001 or maybe 2000 when we had that bottom in the Huey, and then the top for the cycle wave 1, in this case actually occurring in 2008, and then we have the expanded flat count for the wave 2. It did make a higher high in 2011 for the B wave, but just for that reason counts a little bit differently, and thus has different fib fan lines as well, but a little bit more in line with the gold chart as far as when that intersection for the cycle wave 3 would occur with the 1382 extension, but kind of similar here, estimated roughly 3 times the price increase over 3 times the amount of time that original wave 1 took. So a 4,020% estimated price increase, assuming the 1-2 count to the upside. So with that, I'm going to pass it on over to Zach, and he will take you through some of the individual minor charts.
Thank you, Garrett. All right. So now that Garrett showed you the larger pictures for the Huey, as well as for gold and silver, and as well as debunking a lot of those commonly held macro fundamental assumptions, I'm going to take you guys on a quick journey, so to speak, through the forest floor. I know we can always talk about looking at the big picture and remembering to see the forest through the trees. But I think for this approach, and like we usually do for our webinars, we're going to look at a lot of those individual names, but kind of classify those different flora and fauna as we go through. So this bottom-up Elliott wave approach will focus on a few distinct pattern groups among the sector and how things are in sync for more upside attempts this year and beyond. Additionally, I want to take a quick look at past and future resistance points in the GDX and the ETF effect, as well as some other feedback loops that we've seen. So first, I'm actually going to really gloss over this very quickly. But as Garrett was talking about, we have the conditions in the Huey index, and GDX follows this same ABC pattern. But we're looking for what we're looking for as far as a high probability Elliott wave setup. And so that's a very large degree move, a clear ABC retrace coming into a significant low, and then another strong degree move off of that. And the more nested that we can get at those degrees, as far as the 1, 2 at primary wave, the primary degree, and then more 1s and 2s inside of that, then the more high probability that bottom becomes, as well as the more improved the risk reward is, and the more nested and more energy that pattern has, and the closer it is to a possible breakout. So wanting to skip over some of those intro to Elliott wave stuff that we did talk about at the presentation, and moving on to the next slides so that we can get through a lot of these individual names. So Garrett and I, as you guys know, regularly cycle through a watch list as well as our miners model portfolio that contains well over 100 names. And you guys are asking us to look at counts for other names in addition to those that we maintain on our watch list on quite a regular basis. So that gives us a very broad view of this microland in a way that just looking at an index ETF in an index chart, such as the Huey, or a weighted ETF such as GDX, doesn't always show and provides a more limited view. But with that in mind, we do still follow those indexes and the ETFs because there is benefit to looking at things as an aggregate and on the whole. So here we have a daily chart, and we're going to zoom in on the price action that we've had after we have the strong primary degree wave 1 off of what counts as the high probability cycle wave 2 low in the Huey index. Right at that 618 retrace, we have a similar strong impulsive move up, a corrective retrace again to the 618, and then another strong start off of that. So that's what we're going to zoom in on now on the next slide, looking at slide number 4. Or going down to the 4 hour, sorry. So of these 100 or so names, we can identify 3 very distinct camps. Those that held their December 2016 lows as primary wave 2. Those that did not, so those that broke this December 2016 low and either are just now trying to bottom or are still searching for new bottoms as an alternate or as a different deeper primary wave 2, or some even as cycle wave 2. And then the third camp is those that have made a constructive advance beyond this February 2017 high. So now obviously GDX fits into that first group, that we've held the primary wave 2 low so far, but we've not yet made a new low, but we really have not advanced at all beyond this February 2017. So the GDX has pretty much just moved sideways between the resistance at the top in this 25 region and this support region here in the mid 20s or low 21 region. And so there's certainly many charts that fall into a similar camp like this, but as many of you guys know and have been following you know, the charts that we post about regularly and what's in our model portfolio, this is really the smallest of the groups and not what I want to talk about. The largest faction, the one that I want to talk about first, is those that actually failed to hold this low. And you might think that that's a bad thing, but we recognized a lot of these names before that happened and got out when they failed to hold more bullish setups here, or when they started to break this July or the May low here. So we're not writing a lot of those down to new lows underneath December 2016. But within that camp of the names that actually made newer lows, we can follow so instead of getting a wave 1 off of this primary wave 2, most of these count as some sort of B or an X wave. And then we have either 5 waves down, completing a C wave, either at this recent low here in February, or trying to still make a nominal new low here into March. Or some things count as more of an A, B, and a C wave down in a parentheses Y. But that got a little bit confusing to put that as an alternate. So we're just looking at this as things that look at like this orange camp that came down to a nominal new low, or some of them are holding as a wider expanded or just a wider flat in a double bottom. But many of those names that have broken the December 2016 low are still coming into new fib support and looking really strong. It advanced a little bit quicker than I wanted it to. So what I wanted to look at is how this orange count, that the different peaks and troughs in the GDX fit in line with the subwaves for this orange parentheses C wave. So we have the move down, that either of these lows could have been this parentheses wave 2 over here, and we had a couple of attempts at upside that couldn't break out. And so many of those that held lower did not make a higher high in April, definitely didn't make a higher high in September, and certainly didn't make any higher highs in January, as they continued to make lower lows through each of these points on the GDX. And then the next group are those that did constructively advance beyond that February 2017 high. And those, sorry, I'm trying to get, it won't let me switch slides and switch my notes at the same time. So those names, a lot of them ended up filling out a larger subwave pattern for the same intermediate wave 1. So the difference between those that did advance, instead of holding this very, very wide wave 2 at intermediate degree in the start of primary 3 off of this December 2016 low, they counted as a smaller degree wave 1, and then did get a higher high here for a third, held a higher low for a fourth, and then got a higher high for the fifth of that intermediate wave 3. Most of them in this effective 0.50 to 0.618 fib extension region, as measuring the fib extensions off of the primary wave 3 off of this December 16 low. And many of those have already retraced or are holding a retrace or trying to extend a little bit lower to complete that parentheses wave 2 for the wave 2 at intermediate degree. And similar to where, you know, we have these same ups and downs and peaks and troughs in GDX, this was all that they needed for the wave 2. And then whether this was 5 waves up or an ABC for the third is a leading diagonal, which many of them count like, this higher high here in September was pretty significantly higher. And then again, this, instead of being the low point for the 3 in the orange count, often was a fourth wave before getting one more high as a fifth in that intermediate leading diagonal. Some of them count as a 3, 4, and 5 here, and this is a bigger ABC. But as you'll see when we go through some of these individual names, we have a lot of, about another third of those 100 or so names that we follow on a regular basis that fit with this blue count in the as an alternate to GDX that's just moving sideways. And so the really nice thing that we're seeing is that whether things fall into the orange camp of an alt primary wave 2 that's bottoming, or they're in the blue camp, they're both in sync with a pretty significant bottom approaching, if not already in place from recent lows. So now that everybody has these two images of this orange alternate that some names went down to a nominal new low, or the blue alternate where some things constructively made a larger intermediate wave 1 and a wave 2 retrace, now we're going to jump through and take a look at some of those individual charts. So starting first with ABX. And ABX is really important because it is one of the biggest names in all of mining, certainly in the United States, perhaps in the world. There's a lot of fundamental reasons why ABX is important, but it certainly does seem that when ABX is down, a lot of other things are down, and just the opposite. In addition to that, when ABX was bottoming here, GDX made a lower low into December 2015. And ABX was one of those things that Garrett and I were looking at when there was potential for GDX and Huey to extend a little bit lower at that point in a little bit more of an exaggerated final move. But the Huey was right at its 618 retrace for that cycle degree wave 2. And ABX was holding 5 waves up in a 3-wave retrace into that low. So it gave us a very, very high probability setup there. And as you guys, some of us who were with us from the beginning, we had some very nice initial entries in those first moves off of the lows in ABX. Actually even setting up some when we first started the miners portfolio back here in September. But that was certainly one. So ABX had a strong move up, but you can count this as an A, B, and a C wave off of that December 2016 low. It dropped a little bit stronger than ideal back here in April 2017, and then really could not, while this could have counted as 5 up, it couldn't hold an ideal retrace and turn back up strongly, and so has been tracing out a more complex Y wave for a wider wave 2. And it did stretch down and get just a little bit under this 50% retrace. Certainly is potential for it to even extend down to the 10s, but that really doesn't look likely the way that things are starting to look good for a reversal, provided those recent lows hold. Moving on to First Majestic, another one that dropped much stronger than it should have if this was a bullish count off of the December 2016 low, and continued to follow that similar orange count down and hit its 618 retrace for all of primary wave 2, spiked a little bit below that to stay more in lines with the trend lines for this ending diagonal, and has a really nice reversal off of that low. Moving on to AGI. Again, AGI fits with that a WXY or an ABC inside of this parentheses Y wave, very similar to ABX. Couldn't hold, again, dropped stronger than it really should have if this was as bullish as we wanted it to be at the time, and then again dropped lower here, tried to break out, but when it dropped down here and couldn't sustain an impulse, we knew that something was up. So that's now came down right down to its 50% retrace for a wider wave 2 and has turned up very nicely as well. ALO, again, got a higher move up for this B wave beyond that February 2017 high, but clearly looked like only 3 waves up, and the strength of this gap down here had us worried that something else was at play. We were trying to see if it could maybe still hold in here and get a 5th wave up, but when these lows couldn't hold, we knew that it was likely heading down here to a 50% retrace for a much wider primary degree wave 2. Next in that count of breaking the December or whatever low this is that counts now as the A wave, GPL, but still holding, you know, pretty much just a nominal new low that wanted to stretch down here and get to the 38.2% Fibonacci retrace, and is now already has that low. Actually was hit more recently December. It did hold that low and is trying to get this minor degree wave 3 started in the new intermediate 2. CDE, another one that, you know, we were just really, it was enough of a retrace here for us to consider that this was all of the wave 2. And it really has not made much of a lower low than that, but really didn't give us anything clearly bullish off of that low. So the couple of nominal new lows that it hit can count as a pretty awkward sideways ending diagonal, but it allowed it to get right here to touch that 38.2% retrace. Still doesn't have the most impulsive count off of this low, and could maybe get another drop down to the 5s, but we have a feeling that it might be trying to create a leading diagonal for this wave 1 of its larger intermediate degree wave 1. And Mux was one of our initial favorite names that had a really strong setup for a top here early on in August 2016, and so we got out of most of our position there. While it was technically, it was enough to be all of this primary wave 2, we were a little bit less trusting of the B wave up here, and certainly when that started to drop more strongly, a 1-2 was valid, but you know, this has come nicely down towards this 50% retrace for the larger primary degree wave 2, and has a very nice strong reaction off of that 50% retrace, and is holding a nice 1-2, 1-2 in the start of that intermediate degree wave 1. HMY is another one that, you know, had a lot of potential for being all of wave 2 back here, but couldn't hold on and break out in that more bullish count. And so once these lows started to break, you know, we're looking down here for more of a retrace. It really moved out of the channel to get that one more low to the 618 at 1.23. So could have actually counted as kind of a truncated bottom here and starting that new wave 1 of intermediate wave 1, but would like to see it hold a minor degree wave 2 retrace to give us a little bit more confirmation there. And then the last one that I want to talk about in this group, because it kind of bridges the gap to the next set, is CMAX. And CMAX, you know, drifted down to a lower low, hitting its exact 50% retrace for this larger primary wave 2. But rather than just starting the small minor degree wave 1 of its intermediate wave 1, it launched off of that 50% hit and went all the way just past the 0.382 to count as all of this intermediate degree wave 1. So the reason why I say it's a transition is that the other group that we want to talk about are those that more recently topped in a larger intermediate degree wave 1 as a clear sign of starting the wave 2, and have been holding a retrace for this intermediate degree wave 2, which CMAX did get more of a spike down, a little bit lower than the 618, right to about 0.7, and has also started to turn back up off of that. So now moving on to the next group, we start with First Quantum, FM. So again, this is one where it did drift down a little bit lower. You know, it has a slightly different count as far as the top of primary wave 1 and wave 2, but since it bottom in primary wave 2 has held, we have a much more constructive move up, fitting with that leading diagonal potential. And you could count it as complete. Here's a leading diagonal, and maybe this is all of 2, or topping here is 5 and getting the wave 2. But the important thing is that, you know, this is one of those that does have that stronger case for advancing in a larger intermediate degree wave 1. GFI is another one. You could count this leading diagonal a couple different ways, possibly being complete here. Ideally, it gets more of a C wave of 5 and then holds a decent wave 2 retrace, but fitting along that same blue count that we were looking at in GDX. Goro is another one. Still working on the 5th wave, ideally, heading up here towards the 556 region to complete that intermediate wave 1, and then holding a nice shallow retrace for intermediate wave 2. Gold Standard Ventures is another one that did come and make a primary wave 2 more recently, at a lower low than it did in December 2016, but that was a pretty shallow retrace here. So it has a nice 5 down into the 382 for this primary degree wave 2, and has since been tracing out a leading diagonal, which I think is still just for this minor degree wave 1 inside a larger intermediate wave 1. Next is Sandstorm, which again has a slightly different low than the December low, but again has a couple different ways of counting either a nested 1 2 1 2 1 2 count, or either a leading diagonal here and then retrace into here, or just completing that leading diagonal and trying to retrace a little bit more as that blue parentheses wave 2. Now we get into more of those that strongly argue for that very nested series of 1s and 2s. So that's Hudbay Minerals, HBM, off of a little bit of a lower low in 2016 for its primary wave 2, strong 5 waves up, a little bit past the normal Fibonacci pinball extension, getting closer to the 764, but holding a nice ABC for wave 2, and then a new strong 5 waves up, getting to just a nominal new high, making sure that nobody thinks that's an ABC, and then again a shallow retrace here, a strong move up again to a nominal new high, and again holding a series of higher lows and nominally higher highs, so that once it does break out over that 10 region, it can advance very, very quickly. IAG is another one that counts very nicely as that more advanced intermediate wave 1 and wave 2, and has even started a nice 1 2 of a smaller degree inside of minor wave 1 in the start of that parentheses 3 move. Right, FNV is another one that has really moved up very, very nicely as 5 waves up right to that 0.618 as a stronger intermediate wave 1 start to this primary wave 3, and holding a nice retrace there and trying to again start the minor degree wave 1 in the start of that heart of the parentheses 3 of primary 3. Now we get into that last of the group, the ones that more closely resemble GDX. And again, as I said before, it's a much smaller group, and some of these could break out more quickly and still can count as kind of the nested pattern like we saw with HBM and FNV and some of those other things. Or some of them could maybe get a sudden breakdown and spike down maybe on an earnings or some acquisition or other news that might come out to spike to those lows, but they don't need to do either. They could just kind of count awkwardly as a very wide wave 2 off of the December 2016 low, and then just pick up their counts with the rest of all of the bullish names when everything turns up together. But Wheaton Precious Metals is one of those, another one that looks more like sideways choppy garbage, is Argonaut. it had a couple of setups here, and a 1-2, 1-2, 1-2 nested setup is still valid. It has not been able to make any higher highs, but it has made a series of higher lows. So that very nested count in white is certainly still valid, which could be pretty explosive if it gets over the 280s, but could still be trying to fill out more of that larger leading diagonal like that we have in blue. BTG is another one that, similar to BVN, have both moved sideways and held up well, making series of higher lows, but they've really struggled to make higher highs. I think BVN is pressing these relative highs a little bit more so than BTG. But again, there's a lot of coiled up energy there, and while they could just be some kind of alternate sideways chop for maybe a WX, and this is a Y wave triangle that's completing for the primary wave 2, they're easily still in a more nested setup that could get a very explosive move should they break to new highs. And then there's a couple of names that you guys on our site are very familiar with that we've kind of called the honey badgers, that are doing their own thing. A lot of the Australian miners fit into this category, that they're much further ahead. And Kirkland is certainly one where the December 2016 low, instead of being a large degree wave 2, was a 4th wave for Kirkland. And it has continued to fill out this 5 waves up for a larger 5th wave pretty perfectly, and without being phased at all by any of the goings on in the rest of the sector. And then we have KOR, which is actually in a very similar spot right now, looking for support for this minor degree 4th wave that Kirkland was on that previous slide. So these are kind of some of the two oddballs, but most things, like we said, 2/3 of our watch list fits strongly into either that blue or the orange camp. So now we've gotten to the end of all the individual names that I wanted to talk about. And I would like to take a minute to talk about April 2017 and feedback loops. So why did the GDX just move sideways and fail to advance more so in line with, if we have so many of these names that have made constructive progress beyond the February 2017 top? And certainly, we at Elliott Wave Trader had this as a possible parentheses wave 1, but because it came short of the 382, there was a good chance that this was just the minor degree wave 1, and we were going to get a much bigger intermediate wave 1. So what happened to shift that? And I think one of the things that we can blame, that we can point to, is the issues that were going on back in April with GDXJ. So we've talked about it a little bit before, and that's why we really have tried to, we've kind of ignored looking at GDXJ itself and vastly prefer to look at the individual charts of all of those small cap and micro cap miners, which you guys know that Garrett and I love. We think so much of the prudential movement in the miner sector over the next few years is going to come from those smaller names. But GDXJ itself has not been our, it's kind of been we put it on the ignore list. In April, it was brought to the public's attention that there was too much money in GDXJ. Too many people were bullish and wanted an ownership interest in small cap miners. And GDXJ was not able to take an effective position in many names. Either the position would be too small that it wasn't worth it for them to take a position at all, because some of these small cap names are actually very, very small. Or, to take a meaningful position, it would have to be much more than a 10% stake in the company, and that was not allowed by the ETF's rules. So it also wasn't allowed to just have money sitting in cash either. So they started buying shares of ABX and buying shares of GDX itself. As we talked about before, ABX is the least small cap of any of the miners that there are. It is probably the largest of all of the caps. And not only is it one of the largest names that you had being bought in the ETF that was supposed to be investing in small caps, but it also represents anywhere from 8 to 10% at any given time of GDX itself. So not only was GDXJ invested in ABX, but GDXJ was also invested in even more ABX because they were invested in GDX. So they had to unwind those positions, and they had to start selling their stakes in ABX and GDX. So that selling, that plus you had people that were realizing that GDXJ is being mismanaged. So even though the underlying reason might have been something bullish, that so many people were bullish, the small cap miners, GDXJ was getting sold. GDXJ itself was having to sell ABX and GDX, so those were getting sold. So those are dragging down the other individual miners' names. Everything that's in GDX, including ABX, is getting dragged down because GDX is getting sold. ABX is getting sold off more heavily because it's being sold both by GDXJ. It's getting sold by other people that have ABX that are getting worried because it's getting sold off by GDXJ. And it's in GDX, and it's dragging GDX down, which is also getting sold by GDXJ. So you had this massive feedback loop going on that resulted in a significant gap down here on April 25th in ABX. And really, this was while it was still valid to count as a wave 1 and a wave 2, the fact that it didn't reverse immediately from there and started to extend down, really I think was the point where that flipped over and pivoted and needed to come back and restart off of a new primary wave 2 low. But that brings us back to our ABX chart. And while it might have had to, this might have been that pivot point where back in April, where because of outside forces, it had to get a more complex WXY pattern for this primary degree wave 2. It still puts us now in a very high probability point for a significant bottom in a name that should be leading the rest of the market. And with that, I'm going to give it back over to Garrett. And we'll take a couple of requests before we end our presentation. We can also answer some questions if you guys have any questions about our presentation here, but we will certainly be editing it and making it available, as is the normal webinar available most of the time.
Did you already looked at AG, no?
Yes, we did.
Okay. So yeah, Zach went over, I think, a good majority of the charts that some of you requested before we started. You can see AG here. We do have that possible tag of the 618 in our fifth wave. We were looking for one more low, possible micro 5 off there. We just need to see further confirmation off the low to better confirm that bottom in place. And
we looked at CDE. I don't know what this BCEKF is. Oh,
which list are you looking at?
I was looking in the thread.
Okay. BCEKF. Do you know which one that is?
No. Let me see if I can find it. Why don't you do RGO? Oh, Bear Creek.
Is that BCM?
I think so.
Bear Creek has been kind of consolidating sideways for several months here, actually since the bottom back in September of 2017. It was definitely possible that the primary wave 2 completed there. It's just been very messy off of that low, not clearly impulsive enough to really confirm that bottom just yet, at least as long as it's still below this downtrend line. So until we get a better indication of the bottom of place or a cleaner breakout, there is still the possibility of either a retest of that prior low or further downside in the primary wave 2.
Now, that while that a move over 240 could easily be a breakout here, it could also just be a fifth of a leading diagonal off of that September low. Right. So may break and look like a strong pop that's a breakout, breaking that downtrend line that Garrett has. But then it could retreat back under it and consolidate again. But I have a feeling it may not. RGLD?
ALO you looked at yet? RGLD we can take a look at. RGLD is one of those names that fits better in the blue path from Zach's portion of the webinar, where it had a leading diagonal up, has since been consolidating since in what should be a corrective wave 2. It was possible that the wave 2 completed at the December low back here, but similar situation, we just haven't gotten enough confirmation off that low, and there is still room if it needs to see a little bit further down here in the wave 2 with the 50% retrace as the next support at 75.39. HBM, I think you looked at XEC.
I don't think that's a miner.
No.
I think that's a energy company.
SIL should be, no, Silver Bear is SVB. Silver Bull. Which one is Silver Bear again?
I don't think there's a Silver.
There is a Silver Bear as well, but I think SVB must be Silver Bull. Series of 1s and 2s ideally here. The alternative could be a leading diagonal as well, where this is a 1, 2, 3, 4, and the next high is a fifth of that LD. But basically the series of 1s and 2s remains valid above the December 2017 lows. And then the overall minor degree third at least targeting that 100% extension at 56. But based on this one too, it easily could stretch a little bit higher if we get a nice breakout. And this maybe gets moved up to the next fit. And then EOG is energy, NEM. NEM I do think you covered as well. NEM so far has held its series of 1s and 2s. The alternative here would also be a leading diagonal, but likely this would just be the top of a third, maybe consolidates further in a fourth and then a fifth from there. But I do like the series of 1s and 2s a little bit more.
Yep.
CDX. Not familiar with that one. Also not pulling anything up, that's on. CDX I do not have as ticker. SLY, not familiar with that one either. These don't look like these don't look like miners. AU is in the blue camp in that it is still potentially working on the primary wave 2 in this case, unless a double bottom was seen here, or truncated low back in December, has room to head down to 8 before the C of 2 here completes. So it wouldn't be at the top of my list for immediately bullish charts. And then let's take a look at the questions box. Is ABK? I'm not familiar with ABK. There's a bunch of names here that we've never even looked at. What is ABK?
Maybe that was
probably ABX. Yeah, probably ABX. Okay, which obviously looked at that one. HMY, did you take a look at that?
Yeah, we looked at that one.
First Majestic we looked at. We took a look at gold and silver at the beginning of the webinar, but those were indeed just big picture charts, so we can take a look at the more micro view here. Gold is definitely the cleanest, and we have what counts very well as a larger flat down into the 50% retrace, or very close to reaching that at last week's low. For bigger wave 2, but still maintaining that 1-2 count off the December bottom here. We even have a micro 5 waves up off of last week's low as 1, 2, 3, 4, 5, and then this is now a potential expanded flat for another smaller degree 1, 2, where this is an A, B, and C. It may get one more push lower here in the C wave, but if we start to develop a micro 5 up or start to break above further resistance such as 1325, then this easily could have already put in its local low. Similar here on silver, we are still holding that 1-2 potential off of the December bottom, just a slightly more complex wave 2, but held a double bottom here. So maintained above the December bottom, which was important for that 1-2 on the silver chart. Similar, we can get a possible leading diagonal here as 5 up off the low, last week's low, 1, 2, 3, 4, and then 5, and then the same possible ABC. In this case, the C wave, ideally, this would be the 4th of C, and you get one more push to the 618. 1631 is the 5th of C. So both charts easily in favor of the bottom in place at last week's low and set up for the next near-term move to the upside. Dolly Varden. It has gotten a little bit messy off of the December low. It may mean that this overall wave 1 is going to be a diagonal structure, but otherwise continues to hold larger support, basically as long as we're above that prior low here in December, then still constructive to the upside. Still looks to me like a head and shoulders pattern too. Left shoulder, head, right shoulder, and then, any sustained break above this resistance here, kind of in the 80 to 95 range, I think will lead to a nice stronger move higher. It's NOVPC.
I think it's NVO.
Oh, you're right. That's why I wasn't filling it in.
It's an
NVO.
Count. I'm not as much of a fan of that. That 4 came a little bit too deep for me.
Really? I actually like this chart a lot. It was one of the ones that I was suggesting that we add to back at the beginning of February, but based on our overall GDX count, we held off doing any additions until things started to clean up a little bit there. We're still waiting for a little bit more clarity off of the lows in GDX, but I think this works fairly well with pinball. I mean, came to a 1618, back to in between the 100 and 764 for the 4th. Came, I guess, somewhat close to overlap, but obviously has held. If we get a nice 5 up here, that should be wave 1 of 5, and then any pullback would be viable as the wave 2. So this should be ideally 1, 2, currently in the 3rd, and you get a 4th and 5th left in this wave 1. Any other requests that I missed?
I think ASM was requested by Sparrow.
ASM, a chart that bigger picture argues for a ending diagonal to the upside, which is a obviously strike against it because we prefer standard impulse structures. They're easier to predict and easier to trade, but definitely has the potential, obviously, if everything else can end up breaking out and moving higher, for it to do so as well. It would be as the wave 3 of that ending diagonal C, so a larger primary A, B, and then that 1-2 start to the ending diagonal C wave to the upside here. But that because the move up initially off of the 2016 low into the 2016 high, where we got a nice 5-wave structure and a lot of other charts, the vast majority of other charts, this one clearly just breaks down into only 3 waves. It is possible that the 2 here is not complete, where this is instead of WXY into the December low, if that cannot hold, even though we do have a potential micro 5 up from there, that this is instead an A, B, and then C, 1, 2, 3, 4, and then the 5th of the C can take us down to the next support here at 101 at $1, and then this 2 gets moved over. Did we take a look at EXK?
No, I don't think we did yet.
EXK more in line with the blue group.
No,
It is possible.
Orange group.
Orange group, my mistake. It is possible that this was a truncated low here. The issue with the initial move up, actually, you could get 5 in there because there was a slightly higher high here. I was going to say it looks more like 3 waves, but you could get a nice 1, 2, 3, 4, and then 5, and then an ABC from there. So still actually holding that prior October bottom as the potential bottom of primary wave 2 into the 618 retrace. Just looking for further confirmation off the low, some higher highs, higher lows, breaking above some moving average resistance, etc., giving us a better start to that primary wave 3, but overall a nice bullish looking chart as well. WPM.
We did that.
Looked at that one. Okay. All right, then I think, unless I'm missing anything, if I did miss it, quickly type it into the questions box. EGI. EGI has just been kind of chopping and moving sideways for a decent amount of time. I'm starting to wonder if this is a leading diagonal and we ignore maybe not all the spike, but kind of assume that it was a bit of a overreaction to that spinoff that we saw back in 2017. This may be 1, 2, 3, 4, then 5 for the LD though. So I'd say the more important support to hold here is 35 cents. 1, 2, 1, 2 is still a possibility as well, but it's just not really as clear since that spike move to the downside. How best to count this? Maybe one of those things that's more clear. Obviously,
I like just moving over the intermediate 1, 2 as the leading diagonal. I like that a lot.
Yeah, moving over here.
Yep. Maybe it needs one more low, maybe it doesn't.
Yes, Edgar, we will post this video later tonight after it finishes converting. GSR. One's not familiar either. GSR is not pulling up for me. I have strike point gold. No. Yeah, I'm not getting Gold Strike as a company either. Out of space. GSR on the CS.
I have a blue leading diagonal off of the 2014 low.
Oh, here it is, GSR VC. Okay, it was just on the Venture Exchange. That is why. Zooming out, my concern with this chart would be a possible ABC up here, and then I could see the same LD, but I would prefer actually one more higher high as the 5th, where this is only the 3rd. Otherwise, you barely got a higher high for what would be the 5th here. But as an alternative, this could also be an A, B, 1, 2, 3, 4, 5, C. So, not my favorite, especially compared to a lot of the smaller cap or micro cap companies, which this one obviously would fall into. There's some charts out there that just look, so much more confidently bullish than this one that I would much sooner pick. KL, Zach looked at that one as part of his portion of the webinar. All right, I think that should about do it. Just about an hour as well, so that's good. And as always, you guys can ask us for any requests or updates that you need in the trading room, and we'll be happy to post those when we get to it. Otherwise, have a great evening. Hope you guys enjoyed it. See you again next month.
Great. Have a good evening.